Hello, welcome. I'm Deborah, and I will be your professor for the course. And I want to just welcome you to the financial accounting course, which is the first course in a series of accounting courses for the business discipline. This foundational course is going to be quite exciting and with lots of new information. Before I go into the chapter, I do want to introduce you to the process of learning accounting. It is important to note that accounting is the language of business. It is used solely for the purpose of allowing external users, in the case of financial accounting, to make decisions. But to help our external users to make decisions, we need to understand the purpose of accounting, what it does, and what it provides users, so that we can give them the most effective decision-making tools that they need for their business. In that, there are concepts, there are tools, there are lots of vocabulary words that you'll need to learn. But with these vocabulary words, they mean nothing in isolation. They need to be applied to concepts. So it's important as you're reading through the chapters, particularly the foundation ones, which is chapters 1 through 3, you're going to really need to focus your energies on understanding the terms and how they apply to specific types of concepts. So with this particular video series, what I would like to do is stay within 20 minutes, and I'll do my best to do that. But when I go through the presentation, it is important that I'm not going to isolate every single concept, but I will go over concepts that I believe are fundamentally crucial for your understanding of accounting, particularly with emphasis in chapters 1 through 3. So with that being said, let's jump into chapter 1, financial statements. What you'll see here, and it can vary depending on organization, but for this particular chapter, we're emphasizing Walt Disney. Walt Disney is a publicly traded organization, and as such, we can access their financial information, their financial statements in particular. Financial statements provide users with very, very specific types of information. We are giving them numerical information. Now, there are different types of accounting, managerial accounting and financial accounting. In this course, we will be focusing on financial accounting. And we will be looking and reviewing and analyzing and computing numbers. And we will be analyzing these numbers in light of companies and their decisions. So what you see in front of you is a financial statement, which you will learn how to prepare. But note, right now, just notice that financial statements are tools that are used to provide external users with information so they can make decisions. So this chapter, if you've read it and you've applied it with some homework problems, and hopefully if you listen to this tutorial, you should be able to, at the end, explain why accounting is the language of business, how to apply concepts. And again, these concepts are critical, but they need to be paired with the relevant vocabulary, which we will talk about. We want to talk about the assumptions and the principles that really make accounting accounting. And we want to understand what the accounting equation is and how it is applied in business. Also, we're going to evaluate businesses through their financial statements, and that's going to be very important. This skill for number 4 is going to be something that you're going to be developing, so don't worry that you don't get it in chapter 1, because it's not expected for you to get it. But we are going to be talking about learning objective number 4 quite a bit. And constructing financial statements and analyzing relationships. Again, in the fundamental part of this course, you're going to be playing with financial statements, putting them together over and over again, because it's something that is a skill that I think you're going to really need, but you're going to have to work on that skill. So don't worry, in the chapter 1, it doesn't all come together. It will. And then, which I believe is most important, is we're going to talk about how we can make decisions ethically. The right decisions for the right reasons in the right way. And that is it's more than just what's wrong or right. Also, it's about what's the best for the organization and for the people or the customers that organization will impact. So why is it important for businesses? Because we want to know how well our organization is doing. We want to be able to measure their activity, what's going on, the day-to-day operations. We want to be able to process data, and we want to be able to put that data in some kind of very, very organized medium. In this case, reports. Financial statements are one of those. And then we want to make certain that the results are communicated to people who make decisions. Now remember, managerial accounting is going to be focused on internal users of financial information. But for this course, we're going to be focusing on people who are external to the organization, people who are not necessarily managers and leaders, but people who are investors and so forth. So we want to make certain that we have information that they can make a decision, a right decision, a sound financial decision. So the flow of accounting information, people make decisions, transactions occur, and companies report their decisions or their results of their operations. So we want to make certain that people who are external to the organization, for example, individuals like me, I want to know that Walmart's going to be in business. I want to know that Walmart is going to be ethical. I want to know those type of things. I want to know that the services that they provide or the products that they provide are going to be helpful for everybody and will not cause harm, not only now but in the future. Investors and creditors are concerned. They want to know that organization is actually viable, alive, healthy, strong, solvent, can meet its expectations in terms of return of investment for investors or debt management for creditors. Can they pay me back? Regulatory bodies like the IRS and the SEC are concerned too, because they want to make certain that the financial statements are prepared accurately, but they also want to make certain that your revenue is reported accurately for purposes of determining whether or not you have a tax obligation or not. And nonprofit organizations. Nonprofit organizations are public entities, and they actually provide some type of social cause or social mission, and they want to be able to rely on information provided. So we are going to be using that information. We're going to make certain that we have really sound decisions based on reliable data in the form of financial statements. So if we're going to contrast the two, financial and managerial accounting, again, internal entities are going to be the managerial emphasis. External entities and decision makers are going to be the financial accounting. And we are going to know that. So just be aware that there are some slight differences in who are going to be using that information. So when you think about Walmart, when you think about Target, well, one of the things you may not necessarily know is the type of ownership formation of that particular entity. There are a single owner, which is going to be a proprietorship. There are going to be owners that are partners, and there are two or more people who associate themselves together in business for a profit. They're going to be members of an organization, an LLC, limited liability companies, and then they're going to be stockholder organizations like corporations. And that matters somewhat because as we get along into this accounting, you're going to see that the accounting, particularly when it relates to the equity section of the balance sheet, it does vary. It does depend on the type of ownership. So we'll talk about that later. Just right now, we want to introduce to you some of the different types of ownerships, organizations. So proprietorships are going to be single owner. Not necessarily they're going to be retail stores or solo businesses, but that's kind of the general overview. Most companies in this country are going to start off with a proprietorship. Very easy to form, very simple. And in terms of taxation, very, very cheap. But they are personally liable for business debts, and it's definitely something that more people consider when they start their business. I mean, I'm going to start a business, a service business. I really don't need to set up a corporation at this point. And for me, it's just me. A sole proprietor might be the best option. When an organization is a little bit more complicated or requires a lot more input from services and skill sets, individuals may collaborate, work with other individuals, and they form the business. And these are partnerships. They come together as co-owners, and they share their losses, basically how they decide to share their losses and their profits. Many small and medium-sized companies do decide to start a business as a partnership. And in the end, you have to think about the disadvantages and the advantages of both partnership and a sole proprietor when you decide to start your business. You think about what's going to be the disadvantage to a partnership versus a sole proprietorship, or versus a limited liability company or corporation, and what would make best sense for you. All of these different organizational formation strategies are not wrong or right. It's really what's best for your organization and what you're trying to accomplish, and how you intend to accomplish it, and also your anticipation of growth, and how do you see your organization in the next 10 years. So it really does depend on what the organizational owners decide, how they want their company to be formed and what's best for them. So corporations, obviously, and this is going to be very specific to a C corporation. S corporations are not taxed at all; they pass through, but C corporations have to deal with income tax and also dividends. But again, when you're talking about a corporation, there are some reasons why you have to be a corporation. But talk to a business, a lawyer, and others, and in such cases, you have to be a C corporation. You can't be an S corporation or a partnership, depending on what you're trying to accomplish. But again, it's no wrong or right. It's what works best for your organization. So, what are the underlying accounting concepts and assumptions that make up accounting? Why we do what we do, why things are presented the way they're presented, and GAAP is it. The generally accepted accounting principles in the United States is going to be standards by the FASB, and they determine how things are recorded, how the revenue recognition rules, the presentation of information on financial statements, the disclosures, all of those wonderful things. Also, the international financial reporting standards also are part of the frameworks that make up what we do and how we as accountants do it. So the objective really is to provide information about an entity that's useful for potential investors or any creditor or anybody making decisions about that organization's resources. So they want to be relevant, and they want to be faithful. They want to be faithful in that the information is timely and it could be understood. We want to make sure it's relevant because we want to be able to compare it, and we want to be able to be verified. And we have to do it all within the cost principle. It means historical cost. How much did you pay for that? And then your standards. And again, these types of hierarchy is very important because it really gauges the type of things that an organization has to consider when they're actually preparing their information. We have to assume that the organization is going to be separate from the individual. We have to assume that the company will be around for the future. We have to assume that they're going to record at the cost that they pay for it. That's historical costs. And we're going to have to assume in the United States that we're going to be using US dollars as the measure of the dollars on, or the amounts on the financial statements. So the accounting equations: assets equal to liabilities plus owner's equity. This is going to be important too. And I think once you understand what the equation is and how transactions relate to that, this particular equation would make more sense. The main point I would like to state here is the balanced nature of this equation. Its assets are in total, let's say assets in our example is $1,000. And we have our equity and our liabilities. The combination of our liabilities and equities have to equal that $1,000. We always have a balanced situation. We want to see that everything balances. One transaction will affect one or two of the other side of the equation. And you're going to see that quite a bit in a few chapters that when we start working on recording transactions and how they matter and what they do and how it fits into the equation. So an asset is something that an organization owns, and they can provide a future benefit to that organization. So if you're going to receive a benefit from something, it's an asset to you, period. It may be a current asset, meaning you can get the benefit within a year, or a long-lived asset like a fixed asset, you will get the benefit over many years or many accounting periods. A liability, obviously, is something you owe. You owe something to somebody else outside of the organization. Very, very important. Internal liabilities is not relevant here, but external to the organization, you have an obligation. So they have a claim to your asset. Most often the asset is going to be cash, but nevertheless, you have an obligation to pay them something, some kind of asset. In equity, it's going to be the residual. It's really going to be the residual. It's going to be the difference. It's going to be what's left over for the owners, their claims, their interest in the assets. So I always see the equity section as the residual, what's left over to the owners of the organization. The owners could be a sole proprietor, the owners could be the partners, the owners could be the shareholders, etc. So examples are, and these are not exhaustive. I mean, there are so many much more involved items that would make up liabilities and assets, but these are very, very common ones. So when you see them, you're like, okay, if I see cash, I know that's an asset to me. If I see plants, if I see equipment, if I see a computer, if I see a car, I know that's an asset. Or if I see, oh my goodness, I got to make a payment for my debt, my bills. That's going to be some kind of accounts payable, which is operational. obligation or tax is going to be payable to a state or federal government, or some kind of note payable or bond payable liabilities. I have an obligation to pay that money back because they gave me money or they gave me something, an asset of such, that I ultimately have to pay for. So the equity, again, is going to be, and if you're talking about a corporation and we're talking about financial accounting, you're going to talk about paid-in capital and retained earnings. Earnings that's retained. Earnings that the organization keeps and not dispersed out in terms of dividends. That's very important with the retained earning is. Paid-in capital is going to be the difference between, I would say, common stock, par value, and what actually is paid for that stock. So paid-in capital is going to be another item that we're going to talk about. But don't worry about all these terms right now. Just get them in, read them in, and grasp them. And then we will be doing quite a number of transactions and matching assignments that will help you put the pieces together. So, paid-in capital, again, what organizations have received in terms of stock payment. Someone purchases stock, for example. Let's just assume someone purchases stock for $1,000 and they purchase 1,000 shares. And the shares cost 1 cent each. You have to take and record 1 cent times 1,000 shares. That's going to be your common stock. But the difference between the $1,000 and that amount of that common stock is going to be your paid-in capital. And that's going to be what's invested into the business, the paid-in capital. But we're going to do a lot of transactions to illustrate that. And again, retained earnings is what's retained. The organization keeps to maintain or to continue the operations, not returned back to the owners in terms of a dividend or a stock payment. So, components of retained earnings. Again, retained earnings is going to have your revenues for your period minus your expenses, which in essence is your net income. It's also going to have your beginning balance. So, if you make a payment for dividends during the period, you're going to subtract it from your retained earnings. Again, when you pay back your owners for, you repay them for what they've earned for the period, you're going to have to take it out of your retained earnings. And you get your ending retained earnings. And don't worry, we're going to have plenty of homework examples in your textbook to show how that works and what it looks like. So retained earnings is going to show increases in your revenue. Retained earnings goes up when revenues are received. It goes down when expenses are paid out. So it decreases your retained earnings. Dividends decreases your retained earnings. So retained earnings is increased by revenues, decreased by expenses and dividends. And we'll see some examples of that. So, how do we evaluate businesses through the financial statements? We talked about the balance sheet. We actually showed the balance sheet. But the main thing is, what does each financial statement give the user? Now, let's talk about the balance sheet first, which is the third on this list. What is the company's financial position? So that is essentially what a balance sheet provides. It is going to tell you how healthy your organization is. Your financial position is your strength, is your health. It is your overall financial health, and it is the equivalent of your assets equal your liabilities and your owner's equity. The question then becomes, how well did the company do during the year? Well, that's going to be your income statement, and it's going to show the net effect of your revenues minus your expenses. And it's going to show you have an income, which means that your revenues are higher than your expenses, or it's going to show a net loss, meaning your expenses are higher than your revenues. Now, the next question then becomes why did the company's retained earnings change? The statement of retained earnings is designed to provide you the change in retained earnings during the period. And we just went through how to calculate your change in retained earnings in the previous slide. You just take your beginning retained earnings, you add or subtract your net income or loss, and you subtract out your dividends that you've declared. Then the last question is, how much cash did the company generate and spend during the year? This is going to be the statement of cash flows. And this is going to show you how well that you use your cash. Do you have a positive cash flow? This particular statement is also going to show you if you're going to have problems meeting your obligations. This would definitely address questions of solvency and the ability of the organization to meet its obligations in cash in the foreseeable future. A very, very important statement. So the thing that I believe is important, and I love this slide, is what statement do you prepare first? You must have your income statement prepared first, period. You prepare your income statement first, and from that you have the sufficient information to prepare your statement of retained earnings. And then and only then you can prepare your balance sheet. And then you prepare your statement of cash flow. So 1, income statement comes first. 2, statement of retained earnings is second. Number 3, the balance sheet. And finally, the statement of cash flow. And these statements taken together are called the general purpose financial statements, and which you'll almost always see when you're looking at a company that's public, their financial statements. You'll always see the general purpose. You may see more, but you will see no less than the general purpose financial statements. So the income statement is going to tell you the bottom line. It's going to tell you what you're measuring, your income, how much you've earned during the period, how well you're doing with your operations. Is the organization growing in terms of they're having an increase in that income, or are they actually decreasing or doing poorly? And here is the statement of income, or the income statement. And again, this organization brought in, I would say, $48 million. And they have operational expenses of $37 million. And they have other income from operations, and they have income taxes. So they come down to a $7.5 million operational net income. And this particular statement is comparative. Why? Because they're showing 2 years side by side. And this is going to be very, very typical. Some organizations will show you 3 years, but for the most part, you're going to see financial statements in comparative form, which is what you see here. So retained earnings is going to be what's left over, what the organization can reinvest into the operations of that organization. It's going to be netted up any losses and any dividend declarations. Anytime that the board of directors declare a dividend, guess what? It's going to reduce the retained earnings. And I say declared because when you declare the dividend, the organization is obligated to pay that dividend. It doesn't matter when the payment is made. This is again dealing with the accrual basis of accounting, which we will talk about later. The main point is the moment that it's declared, you have to record it at that time. And the payment could very well be 2 months, 3 months in the future. It doesn't matter. You declare it, you have to record it. And here again, it's just a revisiting of how to compute retained earnings at the end of a period of time. You start with the beginning, you add or subtract your net income or loss, and you subtract out your dividends that are declared. And here is an example of the retained earnings. And again, this is just giving you a comparative form. It's a little bit different because instead of it showing it side by side, it's showing it more vertically from top down. But in the end, it's showing you multiple years. And that's very, very important. So the statement, the balance sheet is going to be the financial position. It is going to tell you how healthy the organization is. It is critical. It reports items from assets, liabilities, and equity. It tells the organization's position, how well the organization is doing, how viable it is. Assets can be grouped into 2 categories. Going to be long-lived assets or current assets. And again, 1 year or less is going to be current, and anything that's over a year is going to be long-term. And here is an example of a balance sheet for the Walt Disney Company. And again, it is a classified one because it is showing the different groups. It's grouping assets by current and non-current, and it's grouping liabilities by current and non-current, and it's equity. Very, very important. And again, it is in comparative form because it's showing you 2 years side by side. Liabilities, again, current and long-term is going to be the same. If a liability is maturity, is within 1 year, it is current. If the maturity of that obligation is over a year, guess what? It's going to be a long-term obligation. And here again is a very cute little snapshot of different types of obligations and how they're categorized in terms of current and also in terms of long-term. Remember these terms because you're going to see them a lot. You're going to see also that current, most often, not always, but accounts payable and accrued liabilities are always going to be the first to be shown on the balance sheet in terms of the current liabilities. And then you're going to talk about the current portion of long-term borrowings. And this has to do with if you have a long-term debt of 30 years, but every year you have to pay 1 year's worth of that principal. The year's worth of principal is going to be shown as an obligation on the current portion of an obligation on your balance sheet. And that's important to note. So the equity, again, we talked about it's going to be what's left over to the owners. It's going to be their value of the ownership in their assets. And again, common stock, paid-in capital, retained earnings, treasury stock, which is not always shown because many companies don't buy back their stock, but if they do, they will have treasury stock there, and that's going to be a contra account. It is not going to be a negative. It's going to be a debit balance. It's very important because treasury stock is buying back the common stock. So if common stock is going to be a credit, treasury stock is going to be a debit, and it's going to absolutely offset the common stock. So it's important to know how that's presented on the financial statements. If you see a positive number in the equity section, it's because it's actually designed to offset. And accumulated other comprehensive income, in that particular area is going to be shown less often because very specific transactions are reported in comprehensive income, included foreign translation currency, the pension obligations, etc. And if a company doesn't have those type of transactions, you will never see accumulated other comprehensive income or loss. And here we go. And if you can see here, Treasury. Let's see, Treasury at cost. If you see these numbers here, let's just take a look at this for a minute. 34,000, it's a credit balance. And you see retained earnings, again, a credit balance of 53,000. Other comprehensive income, in this case, it's going to be a loss, so it's going to be a negative number. See, that's going to be an offset. That's going to be on the general ledger, a debit balance. And treasury stock always is going to be a debit balance, unless they decide to buy back the treasury or they resell the treasury stock. But for right now, treasury stock is going to always have a debit balance. And we'll see some transactions later on in the class. And here we are looking at the complete, consolidated, classified, comparative balance sheet for the Walt Disney Company. Statement of cash flows, again, this is the inflows and the outflows of cash, period. They do not show any transaction does not have a cash effect. If it does not have a cash effect, it is not shown on the statement of cash flows. And we will do a statement of cash flows much, much later in the course. But it's important to note, cash in, cash out will always be reflected in this statement. Everything else is completely ignored. They are classified into 3 different activities. And as we go through the course, you're going to really, really dig deep into this one. But for now, just know that it's the inflows and outflows of cash and the change in cash over a period of time, which is what the statement of cash flow shows. And it shows it in 3 different activities. Operating activities, again, everyday hustle and bustle of receiving payment from customers and paying for services and employees, etc. Investing is going to be buying and selling of long-lived assets. And then finances is all going to be about the equity section. Monies that you get from your stock that you've actually received, you issued stock, or repaying of long-term debt and equity. But we'll go through all of the details and the types of transactions that will fit in each one of these categories later on. The main thing here is just to introduce to you the statement of cash flows and what it does and what it looks like. And again, we're talking about the consolidated cash flow statements. Again, we have it in the 3 groups, and we have it in a comparative form. In the end, we want to make certain that our change in cash is noted. And here, the net change is on line 21, which is 510 negative. And in comparative year, it was 544 on the positive side. The net change in 1 year was overall more money going out than more money coming in, which is why the number is negative. So, constructing financial statements and analyzing the relationships among them. Again, we're talking about the financial statements, what they do, and how they're related to one another. And in this chapter, I just want you to be able to visualize it. We're going to talk about all the details of what these numbers mean and how they're applied as we progress through the course. The main point is just to observe that they are related to one another and they work together as a one cohesive unit, showing different aspects of the organization, answering very different questions and serving very different purposes, but in the end, they all work together. So, analyzing an organization ethically, they want to make certain that they maximize their organizational decisions. Everything that they're trying to do for their business, it works well for them, and it provides them the objectives, the goals of that organization. Also, they want to make certain that they follow the law. They make certain that they're doing what's right, and they're doing it in the right way, and they're not taking advantage of others' rights. Very, very important. And the ethical component is going to be make certain that you do more things than just profitable and legal, but some actions just may not be right anyway. You may very well say, well, because we're providing people with food and very quickly, That it doesn't matter that we're putting so much salt in it causes them health issues. Why can't we provide a healthier alternative? It's not illegal to put salt in food, but it could very well be a moral issue of, I want people to want our food, to pay for our food, but I don't want to contribute to obesity. So ethical things. So again, it all depends on the organization and what they're trying to accomplish, but that's the kind of thinking. Sometimes the things are not just right or wrong, legal or illegal. It's about what's best for the society as a whole, and your part in that. So AICPA's Code of Professional Conduct, this most certainly applies to CPAs and any individual who's a member of that AICPA organization. And they are concerned with responsibilities, public trust, integrity, independence, and this all really matters in the area of auditing, particularly exercising due care and the scope and nature of your business. And again, AICPAs are really a fine organization that helps organizations and individuals do the best work as CPAs and accountants. So I hope that this chapter really wets your whistle when it comes to what makes up accounting, how accounting functions, and why it is important. I hope that you learned something from this, and I will talk to you again in our next video in this series.